Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, Josh, we are going to be talking about real estate.
Yes, that's the opposite of fake estate.
Well, I guess it is real, and it could be in your estate plan. But I've never really thought of it that way, but for real.
Yes.
Get it? We're talking about investing in real estate. So how can we define real estate?
Yeah, so let's start with, the most reliable source on the internet, Investopedia, which is like all those PDFs where people can put their own data in.
Yeah.
So, take it for what it is. But they do have a good definition. Essentially, real estate is land combined with the permanent fixtures on the land, whether natural or man-made. So already it sounds really awesome.
It's like land
great.
plus.
So, water, trees, minerals, buildings, homes, fences, bridges. In a sense, the asset class is real assets.
Like a
property.
Kind of like
It's property.
It's something that's there.
Yeah. It's different than personal property, which are not permanently attached. So a car, jewelry, the things that you could put into your house.
Yeah.
But the house itself and the land the house sits on, that's when we talk real estate, what we're talking about. Could be a building, could be a business building, could be a skyscraper, it could be a farm.
Right.
It doesn't have to have a building on it. The land is in itself value as well.
So I guess the natural question to go from there is, why would someone want exposure in their overall financial picture to this asset class?
Yeah. There's a lot of reasons, but it boils down to diversification.
Right.
Because stocks, they move based on reaction to what's going on in the market and the economy. Bonds, they're usually inverse. They react a little differently to the stocks, so there's diversification there. Well, real estate's the same way in that it doesn't always react the exact same way as those other two classes. And so it's diversification in that it's doing something different than the other things that you own.
And specifically, if you own a farm, then you can insert eggs in a basket pun.
Yes.
And you have your eggs in different baskets.
Yes. You're not counting all your eggs in
Exactly.
the one basket. Yes.
But yeah, you're exactly right. It's all about diversification in an ideal overall asset allocation for a human.
Yep.
Not saying any one person, but general human XYZ. You want some things to go up during the same time as some things going down and some things going sideways, or they should
smooth your return.
Not all things should go to minimize volatility in the same direction all the time.
And I was thinking about that. If I am going to own real estate, it's probably a farm in Texas. So that's always in a bull market.
Ooh, I see what you did there.
Because they have the longhorns.
You're going to have some good ones, some doozies, I think, in this one.
That's real estate.
So let's kind of break that down a little bit further. So obviously, real estate, we know what that is. We know why you would invest in that. But there are multiple kinds of investments within, real estate as a blanket.
Yes. So like stocks.
Yeah.
There's all different types, right? There's large cap, small cap. There's different sectors. Stocks have a lot of stuff. Real estate's the big umbrella that a lot of things fall into.
Well, and so beyond that is one side. So you've got the security side of real estate, which generally when you're investing in that, you're going to be investing in what's called a REIT, R-E-I-T, and that stands for Real Estate Investment Trust, REIT. So according to Forbes, this is a good definition I liked, which I'll link in the show notes. A REIT, or Real Estate Investment Trust, is a company that owns, operates, or finances real estate. Makes sense. Investing in a REIT is an easy way for you to add real estate to your portfolio, providing diversification and access to historically high REIT dividend payments.
Okay.
And those dividend payments are why a lot of people like REITs in general, and that's because real estate investment trusts are required by law, because of the way they're incorporated, to pay at least 90%, 90, of their taxable income as shareholder dividends every year.
Right. Dividends are what you get from a stock. That's when they pay out to the shareholders.
True.
Their dividends are coming from the rent payments they're getting from the real estate they own. So, when you think about bonds, they pay an interest because you lent money out. Real estate is when I buy into a REIT or whatever, I then own a portion because I'm a shareholder in this company. The company then may own 30 properties, and each property has tenants, and each tenant pays a monthly rent. And so then they accumulate all this cash, and they're required to keep this nice structure of this REIT to say 90% of whatever I get in here, I have to give out to all these shareholders.
Exactly.
So you see a pretty good yield
usually
out of that. Yes.
Yeah, usually that's pretty good. The flip side of that, so that is security side of things. So you can buy securities, and we'll get into a little bit more about that later, but you can buy, in your investment account, you can hold real estate essentially through those. The other kind of investing in real estate is through physical real estate. So Josh, me,
that'd be like owning a gym. That'd be the physical real estate.
It's like I would pump you up.
Yes.
But yeah, so we own homes.
Yes.
We are investing in real estate through that, and more on that later.
Yep.
But that's one way. So owning home, that is physical real estate. Rental properties, you can become a landlord. We'll talk about more about that later too. Also, some people literally own malls and office buildings and
Somebody's
land.
gotta own them.
Someone has to own them. If it's not a company, it's a person.
Yep.
And then they're collecting rent from that, and they're running a business that way. So physical real estate, securitized real estate, those are two ways to kind of invest in real estate.
And so REITs, the benefit of that is if I don't have a couple $100,000 to buy property,
Yes.
I can buy a REIT that's like a stock, maybe $20, $30, depending on what the REIT is you're looking at, $100, and I can get into real estate without needing a large capital to get started. Right?
And you can make it only a portion of your so say you don't have a net worth of $1 million where you could allocate 20% to be in real estate, and then you can do that. That's fine.
Yep.
Well, if you don't have a net worth of $1 million or whatever, you can have a very small portion through the security side of real estate,
So
and you're a lot less
available
levered
to more people.
Exactly. Cool. So let's talk about some headwinds and tailwinds in the space right now. So we're going to look at it from both the commercial side and kind of the personal side. So headwinds, pricing is a big one right now. In case you haven't noticed, housing, not just here in Findlay, Ohio, where we're sitting and recording this, but around the country, is on fire. It is very, very expensive right now.
A lot of expensiveness.
Your price per square foot is jacked up from where it was even a year ago. There's been a lot of stimulus flowing through the economy, and interest rates are really low. So that is definitely a headwind getting into the space. Now, as a seller, it's a great time to be a seller.
It's a seller's market.
It's a seller's market for sure. But as a headwind of getting into that investment space, that's one. Also, the labor market in general, not very strong. We're still having almost 7% unemployment around the country. Yeah. That could be up or down depending on where you're at living in the country. And COVID-19 is obviously still a headwind as far as, well, it has definitely helped prices go up. It has impacted the labor market specifically. Yeah.
And along with that headwind, so you talk about the unemployment. And last year with the CARES Act and some of the COVID relief bills, they put kind of a moratorium on rent repayment.
True.
In that the person who was actually utilizing that space was not required to pay rent for a period of time.
Yeah.
And so that's great for them. They were struggling. That was part of what that was enacted. Well, the owner, like you mentioned, somebody's got to own that property.
Right.
That person then is not receiving their income. So then their business, their source of livelihood is messed up.
Right.
And so, the headwind is like from that whole space, there's just a lot of disruption.
It's like a trickle up issue. So like tenant doesn't pay, so then the landlord doesn't have the money to pay the mortgage that he probably has on the property.
Yep.
And it's just and then he can't pull an income from his business LLC to put food on the table for his family. It's been tough.
Yeah.
And so there, like you said, some people there have been bills and provisions put out that some of the tenant side of things, or even mortgage holders, have been given a little bit of flexibility. And I think that President Biden actually signed an executive order early on in the first couple of days of his presidency to extend some of those things again.
Yeah.
So that, like you said, aimed at the people who are needing the help. That has certainly helped some, but it's probably also really put some other
it just
people
disrupts
in
the
pinches.
industry because there's a lot of unknown. Is if I owe on that property and it's an investment, how long can I let that go and still make it worthwhile for me to hold? At some point, do I just need to cut my losses? And so the unknown, it causes the headwind as well.
Absolutely. Let's talk about tailwinds. So obviously things are favoring real estate in general. Record low interest rates. We are in. If you look at mortgage rates, if you look at just anything borrowing, your interest is absurdly low.
Yes.
You can get 15-year mortgages for little north of 2% around the country, which is really good, and not that far above it is a 30-year. So that's obviously helping to fuel the housing market right now as people can borrow really cheaply. So that's a tailwind. Also, like you said, CARES Act last spring, and we had another round of fiscal stimulus in December, and it seems quite likely that there's more coming. That has definitely helped some parts of the economy. There have been certain provisions for certain industries which, to no fault of their own, have been essentially shut down, and that's helped them to be able to pay their rent.
Yes.
So some of the REITs have benefited through all of that, and some of the, therefore, even landlords have been able to benefit from that as well. So those are some tailwinds going on. But I think it's probably wise to take a step back and talk, how has real estate historically performed?
Yeah.
Maybe even, compared to the S&P or whatever. So
talking about that, again, when we're looking at performance, when I own a stock and I say, oh, it's done well, I'm done with this stock, I'm trading it for something else, I'm going to sell it, or I need some cash, I'm going to sell it. Real estate, if I physically own the real estate, that's not exactly how that investment works. I can't say, oh, you know what, I need to get some cash, I'm going to take this corner brick off my house and turn it in for some money. My real estate is not as liquid as other investments. And so when I physically own real estate, the liquidity, which means the ability to generate cash out of that, to turn it into cash, is a little bit different, which is, again, comes back to our REITs. When you own that like a stock, depending on what type, there's publicly traded REITs, and then there's some that are less publicly traded, that maybe offer a higher yield, but they have less ability to be liquid. That's something to keep in mind when we're talking through this.
Yeah.
So when we talk about returns, this is how much it's grown or done. Doesn't mean at any point in time you could access that right away.
Absolutely. So let's put some numbers to what we're talking about here. So home prices. This is just prices. And this is measured according to the S&P CoreLogic Case-Shiller 20-City Home Price Index. So they're looking at 20 different cities across the United States and kind of getting an average on prices.
That's one of the longest index names I've ever heard.
It really is so long. So, and then I could get data easily back to March of 2000. So about 20 years.
If they're going to have that long an index, sorry to get stuck on this, it's just really bothering me. If they're going to have that long an index, why did they abbreviate Standard and Poor?
Right.
S&P?
Why didn't they
just go ahead and write it out? I mean, you already got 400 other letters. Just go for
already
it.
dot, dot, dot on everyone's screen.
Just
So, yes, 20 years going back to this very
years just to write that index name.
It's very long index name of an average of 20 city home prices. 20 years back almost. House, home prices have increased 131% around that 20-year period.
That's like Tesla.
131%. Whoa. Okay, think about what 131% over 20 years really is.
You got to annualize that.
It's about 4.15%.
Okay.
Which is positive.
Not bad.
It's not bad. It's certainly not negative.
And this is going back 20 years.
Going back about 20 years.
And so inflation over that same time frame was less than that.
Oh, yeah. Oh, yeah.
So
You'd think you would have had about 2% inflation, 2.5%.
Yeah. And so,
outpacing inflation.
You're winning.
And if you owned a home for 20 years, which most people probably move 4 times in that 20 years, but if you owned that home for 20 years, then you doubled your money, more than doubled your money on that purchase, which is pretty cool. Yep. And that's, while you're living there. Mm-hmm. So that is home prices. Now compare that, and I just spun back around to my computer to get the real numbers. I compared that to the S&P 500.
Okay.
S&P 500 over that same time's up about 175%,
okay,
which is about 4.75% annually, which actually was surprised. It was low to me until I remembered that
there's something that happened twice in there. 3 times in there.
Almost 3 times.
Yes.
So if you look, that's coming out of the dot-com bubble. Mm-hmm. So stocks went down a little bit going back 20 years.
March 2000, it was down.
Then then it rose till 08.
Dropped.
Then global financial crisis happened. Big drop. Then it rose for another 12 years. And then, COVID happened. Mm-hmm. And then the stock market was down. And now it's back up at all-time highs. So there have been, essentially three bear markets in the middle of all that. But 4.75% annualized.
Okay. So real estate's not too far off. Seems to be more like an equity from that standpoint than a fixed income.
True.
And so that's something just to keep in mind. Okay.
So real estate investment trusts that we talked about, and I'm using the Dow Jones REIT Index.
Shorter name.
Okay. Much shorter name. And this is an ETF, and the ticker is RWR, if you ever want to look at that.
RAR.
Rawr. So REITs in general, using this index, have increased about 120% since 2000, or 4.1%. Okay. So dang close to the home price index. Yeah. And I was shocked at how close that was. That's but much really, right really close. So that's kind of, again, compared to what?
Is that total return?
I don't think that those are total returns. Okay. And I don't think the S&P number is total return either. Okay. Those are price index. In there. So there's dividends in there. And if you think stocks in general, over that time, most of that time, we're probably paying more than 2%, 2-ish percent.
REITs for sure.
Mm-hmm. You're going to get another couple. So, cool. Yeah, that's kind of where we're at on a historical performance basis. But, like you said, home prices in general, positive and outpaced inflation. That's kind of the theme there.
So it's not like, for instance, a car, which we talk about, real estate is that those assets that are permanent. Car is not. It's an asset, but it's depreciating in value. My car is not worth more now than it was 11 years ago. So that's,
So, a home is an asset and a car is a grassset.
Yes.
I don't know what that means.
Grassset? No. That's not the right one.
Okay, Josh, when is it a good time to invest in real estate?
Well, the best time to buy real estate
was 30 years ago?
No, when it's dirt cheap.
Oh, stop.
That's
so in Texas, in the bull market, you're going to buy some dirt cheap
Longhorns. But that's honestly, when is a good time to buy real estate? Physical real estate, I would say most people you ask physical real estate, it's their home.
Yeah.
The best time to buy that is when you need a house.
That's a really good point.
Honestly. But, real estate, physical real estate, historically speaking, early in an economic cycle is a good time. Why? Because you're coming out of depressed prices,
right?
Buying low and letting it recover, and you're going to sell it.
And rates are
usually low. I mean, you're coming out of some sort of reason for things right now. Interest rates are at all-time lows because we're coming out of an economic depression.
Yeah, suppose that you were one of the people who had a booming job during the global financial crisis. If you went to buy a house when housing crashed 40%, you probably bought a lot of house for a little bit of money with no interest.
Yep.
Not no interest, but low rates.
Very low.
So that's an example of what that would be. So then, compare that to real estate. We're all talking about real estate. Compare that to real estate investment trust, or REITs. So like physical real estate, interest rates do play a role. They have an interconnected relationship there. So REIT companies, so the companies who are managing that, they take advantage of those low interest rates as to expand their business, to invest in themselves. And similarly to physical real estate, the timing is similar. So early in an economic cycle, prices are cheap. They're buying property up all the time.
Finding it.
And they're doing really, really well at that. And the stuff that they're buying is cheap. So that's really good. As well as when they're coming out of a recession, they are typically only improving their rent collection, so their ability to collect rent from tenants or people, depending on what that is, that really only goes up coming out of a recession. So that's kind of the timing. We should probably note that specifically the pricing side of things has absolutely not been the case in 2020 with the recession we're technically still in. Pricing shot through the roof.
Yes, and so what we saw, especially with homes, like you mentioned, year over year, home sales have just been crazy. Yeah. And, you would think with everything that went on, people wouldn't want to be buying a house. But when you force people to stay inside and they're looking around at wherever they're living, they may think, you know what, if I'm forced to be here long term, this is not where I want to be. I don't want a 200 square foot apartment. I actually need some space to stretch out and breathe.
Exactly.
So we've seen a lot more of that. And then again, when you get 2% interest rate, it's kind of hard not to justify that as a ongoing appreciating asset at a very cheap interest rate.
And like we had mentioned before, some of the stimulus, a lot of the people, so it was kind of a blanket stimulus, 2 rounds of checks we've seen so far, kind of blanket. Yep. A lot of the people who received those didn't necessarily have to use it to pay for groceries. A lot of people did, and that was wonderful. Yep. But the people who didn't, they were able to take that money and put it in either in the market or a down payment on their house or a house improvement or something like that. So that's the reason it really hasn't been the case this time. But Josh, all this real estate, property values discussion, interest rates discussion, it's got me a little jacked up. I need to crack one.
All right, here we go. You want a joke?
Oh yeah,
I got a dad joke for you. All right. So I like to read, and when I'm not reading investing stuff, I enjoy a good mystery or those type of books. Okay, so here you go.
Wait, what's the kids stories though?
Boxcar Children.
Is that right?
No, not quite there. But Encyclopedia Brown.
That's above your reading level.
So here we go. I've just changed though. Now, whenever I have a horror novel, I actually read it in Braille.
A what?
A horror novel.
That sounds
like a scary book.
Very inappropriate.
A horror novel. That's a scary book.
Horror.
What did you think I was saying? Like Goosebumps.
Oh, okay.
Goosebumps. All right.
Joke
I read
flat.
it. I know what happened. I haven't even finished yet. You have to wait till I get done with this joke. You want me to try it again?
No.
All right.
This is gold.
Okay.
I didn't think you would say that.
A horror novel.
Thank you.
A scary book like Goosebumps. I read those in Braille now because when something's bad about to happen, I can feel it. It's not even as funny anymore. She messed it all up. My horror novel.
Man, can't take me anywhere. I'm legit crying.
Oh, man. So let's get back on track. That's
all right.
Last dad joke I'm going to read you out of that book.
I was like, these have to be PG, Josh.
They are. Horror novel. I don't know what you're listening to. I must have been mumbling.
Yeah.
So, investing.
Yeah.
What should we do?
Well,
my answer.
Should
we?
I mean,
it depends. That's what I'm going to answer. Yeah. I'm just ready to answer that right now. But how do you invest? Well, like what should you do?
Yeah, exactly. Well, you might already be investing in this and you don't really know it. Or you hadn't considered it until we're talking about it right now. So if you own your home...
Accidentally. Yes. I accidentally owned real estate.
Dang it, I bought a house.
I signed 3,000 papers on accident.
Seriously, so much signing.
So much trees.
And like, some people legit read those.
That's me. Yep.
Mm-hmm. Nope. I'm like, sign here? Okay. I don't know what I'm signing.
Yep.
Okay,
read it all.
You might be partaking in this trend already. If you own your home / have a mortgage on your home, you're riding the real estate wave. So your home value goes up and down like the market around it. It can be enhanced or detracted by the work you put into it. So yeah, that's cool. And if you own any passive large cap mutual funds or ETFs about U.S. Stocks, you probably already have some real estate in there.
Because like the S&P 500
right.
has a real estate weighting to it.
Yeah, the real estate sector is about 3% of the S&P 500. So even just holding an S&P 500 index fund or whatever, how much of that, you've got 3% of your portfolio in real estate there. Also, alternatively, if you had a lot of time and money on your hands, you could become a landlord. You could buy a house. You could buy a bunch of houses. You could buy multi-family units or office buildings or whatever, and you can become a landlord. This has pros and cons.
Yep.
Number one, it's very pro. This is a con. I listed it in the pros.
Okay.
Con, maintenance intensive.
Mm-hmm.
You are responsible for all the work that your properties need.
Yes.
Or you're responsible to hire someone to do it.
Yep.
So that can be very expensive. You can also just pay someone to manage all your stuff for you, but then you make less money.
Yeah.
So like it's who knows what the right way to do it is, but that's definitely a con. Pro is you really have control. A, you can have something close to you that you could, understand the market and all that stuff and feel like you have an edge. B, you can what you're invested in to the property. And the visibility is really attractive to some people, as well as some people actually, live in like a duplex.
Yeah.
I always thought that was a really cool idea.
Rent out
half,
yeah.
live in half. The rent you get from the one half pays for your mortgage on the other half, and you pretty much are just rolling.
Yeah.
I never really did that, but it sounds like a great idea.
Think about doing that with my kids, have them start charge rent to them. Hey, you living here?
That's right.
Get a job.
You got 4 kids.
Get a job.
You got 4 kids. You might come out money ahead.
They're going to pay all my stuff.
You got money ahead. So those are kind of the two main ways, but also you can, like we had talked about, you can buy individual real estate investment trust stocks. A couple that come to mind. DLR is the ticker, Digital Realty Trust. They do data centers. Welltower, that's like a retirement home sort of,
That's close to our area, correct? There was some up in the Toledo, I believe.
think so, yeah. That's kind of exactly what that company does. There's also one called Crown Castle. They do like towers for cell towers and stuff like that. Castle towers. Why? That should be why they are named Crown Castle. Alternatively, you could buy an ETF in the space. One that I mentioned was RWR, the Dow Jones REIT ETF. Another one is Cohen and Steers. They do real estate mutual funds and ETFs
the polls
as well.
I was talking about. Yep.
Different
steers.
They actually see. That's a really good. I wonder if they have a logo. Cohen and
I'll be
Steers. Maybe they're headquartered in Texas.
That'd be nice.
But they're a huge real estate mutual fund manager, but they've launched some ETFs as well. One of the ETFs is ICF, and that's their general REIT ETF.
And again,
actually,
just a reminder, these are all just things out there to get your brain going. No suggestions, not a recommendation on what you should own. Always think about what makes best for you. Talk to your advisor. But these are just some examples out there to give you a reference.
So let's blanket discussion this. We have nothing prepared. This is off the cuff.
This is just, it says literally on our notes, discuss.
Josh, here's a question.
All right.
Should your home
what
be...
What type of novel do you not like to read?
I know what kind I don't like to read. Okay, that was a horrific question.
See, you can say it horrific, and I can say horror novel.
Should your home be considered an investment?
That's a great question. I think...
Are you going to give me your standard answer?
It depends. But no, I do think I consider a home an investment, but I consider a different investment than most of my other ones.
Right.
And the fact that the depreciation or appreciation in value, I'm less worried about to meet my financial goals. Or in other words, I'm not painting that as a piece of my financial picture. It's not a part of that.
Right.
And so is it an asset? Yeah. Is it an investment? Yeah. Do I need it for my retirement plan to be successful? No.
Right.
And so, again, I guess it goes to the it depends answer. Yeah. Is it considered an investment? I consider it that because of the way it moves in value up and down. What do you think?
Yeah, I actually I think it's an investment with a grain of salt. Because what a lot of people, especially if you've never owned a home, you don't realize is that a home requires a substantial amount of upkeep, constant investment to keep it up to where you want it to be, just to keep it livable. It takes work. It takes money. There are a lot of costs associated with that. So while it is an asset, as in terms of it is something you own, it is something that moves with the market. It's also got its own fair share of liabilities, which is something that we really cannot stress enough. And like you, I would say that, unless you are a real estate investor and that's what you do, like you said, I would not count on the value of your home to be part of your being able to retire at XYZ age. At the equity you can take out of that or whatever that looks like. I think that puts you in a tough spot because then you're tying your financial success to the housing market or whatever. So I think, yes, it is an investment with a grain of salt.
Yeah. And I don't want to, if I really like my house, have to sell it just
to retire.
To get there.
Right.
Yeah. And so I don't want that to be a decision that I can't make on my own for my own reasons. I don't want that to be forced on me. So yeah, that's why. Is it an investment? Yeah. Do I count it as an investment? No. So yeah, you're right.
All right, covering your curveball here.
All right.
How should you view real estate differently as you go through your phases in your financial life?
Yeah.
So from early on, you graduate school, to your middle of your life, to your, when you're in retirement.
Yeah. So for me, when I'm talking with people and we're looking at financial planning, when you're young, you hear the term starter home, right? I'm getting a starter home, meaning I'm probably not going to be there the rest of my life with my family, but it's something that I live in. I would consider that more of an investment than any of the other time periods because I know I'm probably not going to have this long term. So I want to find something that's priced at a point where when I do go to sell it, I'm at least not going to be losing money on that. So from that early stage is, to me, the most likely an investment of all those phases. But that starter home phase is I want to find something I enjoy, but it's also not going to be a burden on me either ongoing cost-wise, or two, when I need to leave, I can sell it at a reasonable time for a reasonable price. Middle of the time period when you're, got your family and you're going to be probably in a house for a good chunk of time is I look at that as something I'm probably going to put money into. I'm probably going to make improvements and go through that, make it my own, but also make it better than when I found it, probably. And so that piece, it's not an investment. It's what does my family need to make my life as easy as possible.
Like you're getting use out of it. You're getting your money's worth out of it in that middle.
It's going to be used.
Right. And generally, that's probably a lot more house than you just sold from your starter house.
Yep.
And maybe as you're getting to, probably more house than you may end up with on the other end.
Yeah. So the retirement piece, that later stage, that's when I think it flips back to potentially being an asset again for retirement. I don't want to be relying on it, but if I had a 2-story house and now I'm in my 70s and going up and down stairs just isn't quite as fun as it used to be, that value of that home, then I can look at it and say, okay, if I'm going to then downsize and get something smaller, I have extra equity in there that can be used for other things. And so it kind of goes in waves. That last piece too, there's a lot you can do with real estate if it's your property, and like there's reverse mortgage and all these crazy things. But from a cash standpoint, when you have equity, there's home equity lines. I mean, there's a lot of ways you can access that equity when you're less worried about those day-to-day things. You know, when you're in retirement and your cash flow is good and your plan's all set, there's a little more flexibility there. So I think it goes in waves from where you're at.
I think we should save it for another topic for another day, but having a mortgage in retirement is a good discussion.
Oh, that'd be a good
because
discussion.
So just keep your ears tuned, everyone. We will revisit that topic.
Yes.
I know we could talk a whole episode about it today because there's pros and cons to it.
Yes.
And, maybe we'll do one of those episodes real soon. So thanks for being here this week. As always, check out our free gift to you. It's a brief list of 8 principles of timeless investing, overarching investment themes to keep you on track to meet your long-term goals. And no, we don't specifically talk about real estate in that because, like we had mentioned, not really something that we're putting, betting the farm on. See what I did there?
Nice.
For your financial picture there. But, it definitely has its purpose. So check it out. It's free on our website. Josh, how can people help us grow this podcast?
Yeah, make sure you subscribe however you listen to us. Subscribing allows you to get the most recent podcast every Thursday, which is great. Leave us a review on Apple Podcasts. If you listen there, it's great. Helps us rank higher, and that only helps more people find us. And then if you have any cool ideas or topics, or you have a question about real estate, shoot us an email at hello@theinvesteddads.com, or check us out on our website. There's a link there where you can contact us. Then if you know somebody who's talking about real estate, thinking about real estate, share this episode with them.
All right. Well, until next Thursday, have a good week.
I'll talk to you later. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.